It's quiz time.
Quiz time.
How'd you do last week?
I don't know.
Okay, here's the questions. What does pulling demand forward mean?
Pulling demand forward, as we talked about last week, is basically government intervention that goes into the market, encourages people to spend money now rather than later. And so what happens is you get a peak in spending currently, and then, as I did with quarters last week, you pulled all that demand forward, and then you get this lull because, people have already spent the money.
Like the housing
and
tax
cash
rebate
for clunkers.
Cash for clunkers. So here's what happened because of cash for clunkers. When everyone went out and bought their cars, now there's a lull. So it says car sales in August were their softest since August 1983.
1983?
Yes, the worst such industry-wide gap in 27 years. And U.S. new vehicle sales fell just short of 1 million vehicles, a drop of 21% from a year ago.
Yeah, so we pulled all the demand forward.
Everybody has their new vehicles, and
nobody wants
no
one now.
sales now.
Nobody wants one now. So that's the issue with demand pulling forward.
Okay, next question was, what are the 4 components of GDP and which has the most impact?
Well, this one's simple. Right out of an economics textbook. C plus I plus G plus NX equals GDP. C is consumers, I is investment, mainly business spending, could be residential homes and so on. G is for government, and government spending at exports is how much we spend overseas versus how much they buy from us. And of course, consumers are 2/3 to 70% of the economy.
We're important, so go consume.
Go! Yeah, you guys go consume. I'm gonna, keep being smart about
save
things.
Save and deleverage?
I'm gonna save and deleverage. Yeah, that's exactly right.
Okay, next question is, why is the Hindenburg omen important?
Because of the buzz. It's all about the buzz. The Hindenburg omen is, it doesn't really make sure you can predict anything. Sometimes it's predictive, sometimes it isn't. It's just a way to look at the markets. But if people start thinking about it,
there's a lot of people that follow it.
And a lot of people follow it, and all of a sudden, just because we won't take action doesn't mean that other people's won't. And markets are people, and people are fickle, and so markets are fickle. So you have to pay attention to things like that. Otherwise, you can get caught, and for no reason other than people think that they should sell, they will sell.
Okay, and last question is, what can be done to improve the economy?
Well, that's a difficult one. As I said last week, it's my opinion that there's not much they can do. They can do some fiscal things by, maybe some tax cuts. They might do some things with mortgages. Mortgage rates are already low. Maybe try to refinance some mortgages of people underwater, but I don't know how that's going to work. Basically, we're in a tough spot fiscally, especially because we can't borrow any more money, or we're not much more money anyway, because we've run up these huge debts. Monetarily, there's plenty of money in the system. There's nobody saying interest rates should be lower, and there's nobody saying that they don't have money to lend. So, monetary policy is kind of pushing on a string. Everybody has money. We'll talk about that in the next segment. So unless they do something major structural change in the way we do things overall, time is the major factor.
It's
got to work itself out, and it's going to be a while. That's why that word deleveraging is coming up more and more in our vocabulary.
Well, what do you have for us this week?
Okay, so just a few easy questions this week. So the first one is, what is the main concern of slowing economic growth?
Okay.
What data do you watch to see if a firm has credit problems? The third one is, why not just ignore rumors?
Why not?
Why not? Might be a reason. And why can't the Treasury just keep on spending? We'll get in that in the next segment, so stay tuned.